In Chapter 10, we're going to look at the valuation of financial assets. And let's try to put together, before we get started here, sort of a picture of how Chapters 9, 10, 11, and 12 fit together so we can see what it is we're trying to do. In Chapter 9, we learned about present value, how to calculate present value. In Chapter 10, we're going to use the tools we learned in Chapter 9 for present value to value, we'll circle this at the bottom, to value stocks and bonds. Now, the reason we're going to value stocks and bonds here is, of course, as an investor, you might have an interest in, well, how do stocks and bonds get valued? But really, we're also interested in looking at this from a manager's perspective. So we're going to look at how stocks and bonds are valued, and then we're going to sort of turn these valuation methods inside out and solve, because in many cases we can see what a security is actually trading for, so we know how the market is valuing stocks and bonds. So we're going to turn those models inside out and solve backwards for the required rates of return. In other words, the discount rate. The manager wants to know what is the discount rate that the market is using for my stocks and for my bonds, because he's going to use these discount rates, referred to also as required returns, to make judgments as to how much the firm needs to earn on its investments. So he's going to use this information about what the market is demanding from his firm in Chapter 11 to come up with a cost of financing the firm as a whole. So his stockholders, his bondholders in aggregate are supplying capital to the firm, and he's going to use that capital. He needs to know what the capital is costing him. It's easy for interest-bearing securities. You just look and say, well, the cost is whatever interest I'm paying. But for stocks, it's less clear, because in some cases, stocks are not paying a dividend currently. But that doesn't mean the stockholders don't expect to earn a return. They do. They expect one day to get dividends. And the manager needs to have some understanding of, well, what return are they expecting over the long run out of my firm? Therefore, what does the firm as a whole need to return? And with that information, they're going to make some judgments, which we'll explore in Chapter 12, on which projects to take. So we can work the other direction now and think of it in this way. In Chapter 12, we're going to figure out, well, which projects should I take in order to earn the level of return that I need to satisfy bondholders and shareholders individually, the required rates of returns for bondholders and shareholders, and I will observe from that various stock values and bond values for the securities that I have outstanding. So that's sort of the way we're going to tie all of this together. For right now, we're going to look at some valuation. We'll be looking at some basic valuation concepts in this chapter. The value of a financial asset is based upon the present value of the future cash flows. In Chapter 9, we learned about present value. We're going to have to estimate cash flows and then apply the present value methods that we now have exercised and we understand. The required rate of return that we're going to use is the discount rate. So the discount rate, I'll sometimes use discount rate and required return interchangeably. For a stock, the required return is whatever stockholders are requiring that the security return in order for them to be willing to own the stock. If the returns look like they're too low, the stock price will fall until the time when, given the level of the stock price, investors can expect the return that they require from it. These required rates of return, and therefore the discount rates from the manager's perspective, are just determined by the market. The market decides what price to put on the stock. The market decides how much interest is enough in order to be willing to lend money to the company. And these discount rates are going to be based upon the perceived level of risk that the company has and that the individual security, whether it's a stock or a bond, possess. It's also a competitively determined rate. So many companies are out trying to raise money in the bond market, and the interest rate that a company pays isn't something that the managers dream up. They get the best rate they can, but they have to compete for money. If they're not willing to pay enough in interest, no one will lend them the money. So when we observe an interest rate for a company, then what we're also seeing is what the required return by the market is. An implication that we have is investors are willing to accept a lower return when the risk level is low. If the risk is high, they require a higher return. It's also worth recognizing that if managers, I'll read this last line, efficient use of capital in the past results in a lower required rate of return for investors. In other words, if managers in the past have used capital efficiently and effectively, shareholders trust them. They look and say, management is competent, they're using our capital in an efficient way, they're trustworthy, and therefore there's a lower required return from investors going forward. You might think of this as the ethics check in the markets. If managers have been, in a sense, ethical with their investments, if they've been efficient in the use of it, haven't squandered the money, the shareholders, bondholders are willing to lend with greater certainty at a lower cost. So this is the reward for doing well to begin with, for doing the right thing all along.